Other asset class which has been doing really well is gold. Is it still the time to look at this particular commodity? How much can one put into gold at these levels?
I think it's a very good idea to hold gold, maybe 10% of your portfolio. I think gold is very important to have. And as you know, one of the reasons why gold prices are moving up is because of Indian buying. With per capita income moving up in India, of course, there's going to be more money going into gold because Indians, traditionally love gold, like to have gold, and consider gold a currency.
Mark Mobius is of course correct. Indians love gold, and as they become increasingly wealthy, they will likely continue being one of the largest physical gold buying markets in the world. China is a similar story. Both countries and Turkey are large buyers of gold per capita, yet only mining small fractions of the physical gold they typically demand year on year. Increasingly wealthy nations like China have set up major physical gold exchanges, whereas of the latest gold spot price dip in early August 2024, 2 months back, they were seen increasing their deliveries of physical gold off their local Shanghai Gold Exchange.
Maybe 10% of your portfolio. I think gold is very important to have.
Mark Mobius is a renowned figure in emerging markets investing. At age 88, he's still going strong. He has an estimated net worth of approximately 60 million fiat US dollars as of 2024. His wealth is a result of his long, successful career in investment management spanning several decades. But his suggestion to investors to hold a 10% gold allocation is not common in the modern Western financial world. That said, in the West, gold allocation trends are changing. Commercial bank UBS has begun pounding the table for clients to move up to 5% gold allocation, with forecasts of a run towards $2,900 an ounce gold in late Q3 of next year, 2025. But the issue with these tiny allocation suggestions remains the damning backtested data. From 1968 to now in 2024, backtested data suggests when measured against the S&P 500, U.S. stock market index, and the U.S. bond market's performance, the correct risk-reward allocation to gold bullion over the last 55 years has been around 20% of one's liquid investments allocated to gold throughout. The other issue for investors today is most likely remain unaware that we have likely entered bear markets for both bonds and stocks, which are typical in paper asset 60-40 investment portfolios. According to data, in the last 125 years of financial history, we've gone through 6 eras of 60-40 bond stock bear markets in which performances have been sideways in real terms versus inflation. They have averaged more than 11-year time spans. Now, beginning in these 2020s, it appears we've entered the 7th bond stock market bear combo. Hence, the need to pivot in aggressive fashion toward gold bullion allocations now, not later, at higher relative values. Globally, the world central banks are on the aggregate buying gold bullion in tonnage never before seen in financial history. Meanwhile, we've entered what appears to be another growing rate-cutting and monetary easing cycle. In other words, more fiat currency and burr is coming. We can say this because year-over-year data is screaming so globally. And no, this isn't real money that's growing so rampant. It's simply fiat currency units created from thin air that barely store value over the average human lifetime. The fiat US dollar dominated free-floating currency regime remains afloat, at least for now. But we just added another $345 billion to our now $35.7 trillion US federal debt level. And yes, you could of course try and run to the world's second largest fiat currency unit, but newsflash, they're in about as big a debt and unfunded liability quandary that we are in the United States. The fiat euro will keep losing to gold bullion as well. Last week I reminded you that even if we use the increasingly rigged US government price inflation data, the seemingly large record nominal gold price high at the moment is still well off the 1980 high using their rigged data working backwards. But if we use the old pre-1980 version to gauge price inflation without rampant hedonic adjustments and inflationary data lie substitutions over many decades, the Shadow Stats 1980 gold price high is nearly $30,000 an ounce looking backwards. But where the gold spot price goes in nominal fiat US dollar terms throughout this decade into next is not what one should be solely focused upon. Rather, we should focus on what in real terms an ounce of gold can buy you in real-world goods and services on a historic basis to know when to increase and or lessen one's gold allocations. For instance, today, the S&P 500 U.S. stock index closed at 5,751, meaning it still costs over 2 ounces of gold to afford one share of that current U.S. stock bubble. I'm not interested in buying U.S. stocks on a relative value basis until at least we again see a 1-to-1 parity or below, meaning the spot price of gold matches the S&P nominally. As this building gold bullion bull is going to likely end up making 2011 look like a grade school dress rehearsal. A similar but even more aggressive story on the silver side of this relative value equation. In terms of the S&P 500 currently valued by spot silver, we're in a bubble only outdone by the year 2000's version. I don't care about swapping silver for U.S. stocks until at least this ratio falls below 50 back towards the pipsqueak silver bull market 2011 lows. Now on the other side of this short break, we're going to come back and look at some short-term factors for what's next, as well as long-term fundamental supply-demand factors that are lining up to make this building bullion bull market an all-timer. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
The history of gold is vast and deep, and history is important. Part of a group with over 170 years of history in precious metals, Arger Heraeus has a proven track record refining some of the world's highest quality gold products. As one of the world's leading gold refiners, Arger Heraeus is on the forefront of cutting-edge technology. That's why when SD Bullion was looking to make a gold bar of the highest quality, we chose to partner with Arger Heraeus for their rich experience and history. Our goal was to create a bar that visually expresses some of the core values at SD Bullion, our love for our country and our faith. Introducing the brand new Cross and Flag gold bars, featuring a beautiful image of the American flag draped around the cross, imprinted upon 4 nines fine gold. These bars are available in 4 different sizes, and each bar arrives in assay with a unique serial number. Serial numbers 1 through 20 for all 4 size options will be available for purchase while supplies last. A separate listing for serial numbers 21 through 100 will also be available, and all other serial numbers will be shipped at random. The SD Bullion Cross and Flag Gold Bars, the first co-branded gold bar in SD Bullion history. And history is important.
So I went down to the water and found my fate, because I don't wanna be stuck in the good old days. That's when you say, I swear you ain't seen nothing yet. Found my faith, bowed my head for the blessings that come my way. There'll come a day, I swear you ain't seen nothing yet.
Exclusively at sdbullion.com.
The spot silver gold markets traded and closed in mixed fashion on the week, with more relative strength in silver than in gold. The spot silver price finished above 32 an ounce bid, while the spot gold price closed just over 2,650 an ounce bid. The spot gold silver ratio dipped to 82. Another fiat US dollar pump occurred today on yet what seems to be another phony jobs report that will likely be adjusted lower months from now. Short-side trading algorithms, of course, attempted to shake out gold longs, but the bid returned quickly in a reversal in price spike intraday shortly after the jobs report was issued. Now, this coming Monday is the final holiday with Chinese away from their trading desks. I look forward to some price weakness perhaps early in the week and remain interested to see what follows once China returns to the gold market Tuesday and beyond. The Russian Federation recently announced they'll begin buying silver, platinum, and palladium for state fund stockpiles. Annual allocations of $500 million fiat US dollar equivalent are now set to spin forward in Russia on the aforementioned precious metal state stockpiles. In terms of the silver market, technically it appears on the chart that we're looking at, we're beginning to make the bull market spot price climb towards higher 30s an ounce and possibly 40s an ounce sooner than later. And with the world's physical silver market and record supply deficits for years behind and to come, this chart does a good job of showing just how pipsqueak the 2011 bull market was in underlying supply-demand fundamentals, with virtually no major deficits like we are seeing in the 2020s. Metals Focus had an insightful publication this week about the ongoing supply-demand issues in the world silver market, asking and then trying to answer the following question. Can silver mine supply meet increasing industrial demand? They write, the silver market is experiencing its fourth consecutive year of structural deficit, driven primarily by increasing industrial demand. The deficit is expected to persist and so notably deplete above-ground stocks. The critical question now facing the market is whether mine supply can respond to restore balance. A silver mine supply after 2 decades of consistent year-on-year growth peaked at 900 million ounces in 2016, and during that period, the silver spot price, despite some volatility, averaged $13.30 an ounce. Since 2016, the silver price has averaged $20.70 an ounce, with current spot prices at around $31.50 an ounce. However, despite these higher prices, mine supply in 2024 is projected to be 62.8 million ounces lower than the 2016 peak, representing a 7% decline. Looking ahead, the structural deficits are expected to support silver prices, which are forecast to ultimately reach record highs over the next 5 years. However, mine supply growth is likely to remain modest, with only minimal increases globally. The price inelasticity of silver mine supply is largely due to the fact that 55% of silver is mined as a byproduct of base metal operations. Although silver can be a significant revenue stream, the economics and production plans of these mines are primarily driven by the markets for copper, lead, and zinc. Consequently, even significant increases in silver spot prices are unlikely to influence production plans that are dependent on other metals. They go on in the report to conclude the following. The timing of new supply will be critical, as developing a mine takes many years. This means that it's implausible that new production could balance the current deficits over the short to medium term. For those shortfalls to end, we are instead dependent on recycling and demand to react to the forecast price rally. This would come soonest in the price-sensitive areas, mainly silver jewelry and silverware. However, we also need that to happen to retail silver investment, which may not immediately occur should investors buy into the rally rather than profit take. And to industrial demand through thrifting and substitution, which itself can take a year or two as products are redesigned and recertified. As such, it is only continued drawdowns from above-ground stocks that can balance the market in the next few years. With silver supply deficits unlikely to be met by ongoing supplies for years to come, the only way to finally begin returning the world silver market in surpluses rather than deficits is to finally allow the multi-decade suppressed spot silver price to return toward its ancient nominal price high of 50 an ounce, and then eventually break beyond that level into an eventual mania phase. It is in that coming mania, I maintain, that the shadow eastern price of silver, currently around 380 an ounce, will eventually return for a future fifth meeting with the red silver spot price line on this critical full fiat currency era chart. By the time this occurs, it will likely begin to make sense to rotate some gains out of silver and gold into other asset classes, probably around the same time that future U.S. stock market investors are swearing off that asset class for its terrible underperformance in real value terms to come. That's going to be all for this week's SD Bullion Market Update. As always, to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.